The Honest Money podcast is brought to you by Prescient Investment Management. We consider everything to give you the advantage. It's the future of investing. Prescient Investment Management is an authorized FSP.
Welcome to Honest Money. We're doing a special episode today, and I was talking to our guest off air, saying I almost want to call this the Good News, the Good News podcast. So I'm thrilled to have Bastian Teichgreeber, who's the Chief Investment Officer of Prescient Investment Management. And we're talking today about kind of a batch of good news that's hit South Africa recently, and I thought it was worth getting Bastian on because he understands this stuff way better than me, and just to explain kind of a few of the things that have happened and maybe into the future why all of this good news starts to make an impact on our daily lives. Bastian, thanks so much for joining.
Thanks for having me on the show, Lauren.
First one, just to go a little bit back, is we were on this weird thing called the grey list, and then we worked. I want to say the government, but actually maybe private institutions worked really hard with government to get ourselves off this grey list over a period of just longer than 2 years and under 3 years, and now we're off this grey list. What does it actually all mean?
Yeah, it's an important point, Warren. And the grey list is not just a grey list. It's really important to be off that list because the research from the IMF suggests that countries which are on that grey list long term receive significantly less capital inflows because it's just tougher to invest in a country which is grey listed because there's more frictions, there's more requirements, there's more compliance boxes which needs to be ticked. And just being off that grey list makes it easier. And obviously, just think about it from a signaling point of view. So you get onto the grey list if you're not good in terms of anti-money laundering laws, if you're not good in terms of anti-corruption laws, if you're not good in counter-financing terrorism laws. So with all of that, it sends the wrong message if you're on that list. And being off is obviously creating certainty, creating confidence, and shows investors that South Africa is a location where you actually want to be investing.
Okay, so it's almost one of those things where it's like a ticket to the game. You want to have the ticket so you can be in the game. It doesn't necessarily mean you win anything, but if you don't have a ticket, you can't play. And now we're back in the game again.
That pretty much describes it well, I guess. Remember, financial markets and investments are all about confidence, right? So you need to send a lot of signals of confidence to attract foreign capital. We do know that in South Africa, the way our economy is designed, and this is not a bad thing, but we do depend on foreign capital to come into our country to help us grow infrastructure, to help us to grow our economy. And that attraction of foreign capital has definitely been one of our weak points or weak spots over the last couple of years, because we kind of did the opposite. We did not create political certainty and not create investor confidence. And that's part of good news, which you basically spoke about in your intro, that hit the mark because it basically shows that we are serious. We do have the political will with our new government to do the right things. So while this is not everything yet, it's an important step in the right direction.
And then maybe it's a nice way to introduce the next sort of piece of good news. And there are probably two pieces of good news that are tied together. So we had the finance minister introducing his budget. And I always feel like the February budget is kind of like the principles of how we want to do and how we want to think and everything. And then the October budget is actually the nuts and bolts. Like this is really how we're going to spend our money and the like. And my own sense, not putting words in your mouth, but my own sense of this is it's kind of like, the person that was overspending on the credit card and was starting to hit the limits, now realizing that and actually spending a little bit less than they earn, every single month. And now it's into the second year and potentially into the third year. And then using that bit of extra money to start paying down the debts, which are draining the economy. So it feels to me like good news from a budget point of view. Like we're behaving like responsible people and almost want to say adulting now. And then we get soon after that one of the big ratings agencies saying, we see your budget, we see your discipline, we're actually changing our rating of you from, I think it was 3 levels below junk status, and now we're 2 levels below junk status. And I almost think to myself, you made the point about momentum and about perception. The rating going from 3 below junk to 2 below junk on its own is not a big issue, I think. But what it does is it's the signal about somebody out there thinks we're doing things well, and we're starting to build a positive momentum.
That's 100% right, Warren. I literally agree with every word you said. That momentum is important. And I mean, there is empirical evidence that ratings do experience some autocorrelation. So, technical term, but what autocorrelation means is that the direction you travel in is likely the direction you will stay on. And if you start to do the right things, then eventually that becomes a self-enforcing prophecy, so to say. And you can upgrade your rating again. And I mean, even that one step up is not necessarily meaningless. So it helps to bring down funding costs a little bit. We could see on the back of that funding costs coming down, or government bonds rallying, government bond yields coming down. So I do think there's a lot of good news in it. And you mentioned the spending, and that's spot on. So we have a debt to GDP ratio, which now seems to be peaking earlier, and which seems to be stabilizing at a lower level. That's the one side of the positivity. But what you didn't mention, Warren, is that we also gave the green light to a lower inflation target at 3%, also being part of that budget. And I think for me, that almost was the highlight. Not just that we gave the green light on that lower inflation target, but also the way we gave it. It was no ifs and whens attached, no strings attached. It was crystal clear. We're going for 3%. And that's a big step forward for our economy. It creates macroeconomic certainty, macroeconomic stability, and it once again creates, through all of these channels, investor confidence, and with that, more investments, hopefully. So throughout, good news, 100% right.
So Bastian, maybe just to explain this this inflation target a little bit. So, let's just say we were in that 3 to 6 band, and we were floating around there, and so it seems to me that from the outsiders would say, well, I mean, that's quite a big band. I mean, it's what are you actually aiming for, and when will you cut interest rates actually? Like if inflation is sitting at 5.9, would you cut interest rates? And then, you don't get a clear response from the Reserve Bank. So it feels to me that if we're at 3%, what I do like, I know they've still given them, I think, is it 1%? So you could be at 2 and you could be at 4, but actually it's 3 is the number. But the one critique I've heard of this is, it doesn't really make a difference tomorrow, because if we issued last year a 30-year bond, and let's just say we were, as a country, and we were saying we're going to pay 11%, and inflation does stay around that 3%, it's a real return, it's a growth rate or a bond rate of 8% above inflation, above the CPI target. But next year, if we issue a new 30-year bond, then we're not going to be issuing at 11. I'm guessing that's what you're talking about around that funding cost. We should have the capacity to issue a lower interest rate and still allow, or still create it as an attractive buyer or product for investors to buy.
100%. So I do think it has an immediate impact, to be honest. You can fund, and if you're worried about those bonds which you've issued a while ago, you can issue new bonds at a low level. So I think it has an immediate impact, absolutely. And that band, removing that band and moving to a set target which is much lower, that was really like at the heart of the success here, because inflation is like, you can economically break inflation or inflation expectations down into 2 components. Basically, it's not just inflation expectations, which is clean where you think inflation is going to be, but then there's also an element of an inflation risk premium. So that's basically that uncertainty. So I can say, I guess inflation is going to be at 4%, but maybe it's going to be 6%. And we can measure that risk premium has compressed quite dramatically. So people are way less worried now that we will see those upside spikes on inflation. And that really means that there's room for our government bond yields to compress. That's already what we are seeing. And with that, we can refund or fund our government cheaper. So I think it's throughout a win. I think it's an immediate win as well. I think it helps in this very moment already. Because the budget has been tight and it will stay tight. Even if we're saving a little bit more and spending a little bit less, there's also money which needs to be spent to get our economy growing. So with that, pulling in the right direction here in terms of interest rates, that is very, very good news. So it's a big win. And we, again, have empirical evidence for other emerging economies which have done the same thing before us, that it all helped, or it all moved funding costs in the right direction. And South Africa will be no different here.
So what I didn't realize there is we can issue then a new bond. Let's say, I mean, it'd be crazy to issue a lot of bonds in December when everyone goes on holiday. But let's just say we issue in the beginning of the year, and we can then take that money that we've now raised and use that to settle the bonds we issued last year at a higher rate. And that immediately drops off future funding costs.
If you really want to, you can do that. But just remember that every week there's issuances of government bonds. So it's not that one bond gets issued and then it sits there. So what the government does, or the Treasury does, is basically taps into those existing bonds and tops them up on an ongoing basis. So basically, it's not the case that bond is issued and now sits there. So it gets repriced every single day, and we tap into that every week, literally. And now if we tap into a 10-year bond, we can tap into that 10-year bond at a lower yield. So the impact is very, very much immediate. So that's very important to understand.
That's why I'm glad you're on our recording today. I didn't get that. So what's aligned with that, which is then we also saw the finance minister, or sorry, not the finance minister, but the Reserve Bank cutting our prime interest rates again by another 0.25%. And again, it's not necessarily just that it's 0.25 in isolation. It's 0.25 on top of previous cuts in the past. And that's one that maybe is a bit more intuitive that we all understand, because if we've got a mortgage or a credit card or a car loan, it immediately means that we get a bit more money because we were spending a bit less on refinancing. Hopefully, we're instilling good discipline and we're all paying off our debts a bit faster because of it. But it's yet another positive sign, and it's yet another thing that just helps give a little bit more impetus to the economy. When interest rates are high, it's punishing to individuals and businesses.
100% agreed, Warren, and that's very important to understand, because you basically have squashed inflation expectations, or at least the inflation risk premium, which enables the Reserve Bank to lower interest rates and still not worry about inflation. And that's a very, very good thing, because what we've seen after the budget and after implementing the 3% target is not just certainty that we would deliver this rate cut, which we've now seen, but also certainty that there will be more rate cuts. And we can see that in market pricing, that the big shift actually hasn't been that we now had that cut. That cut would have come anyway, so that was pretty well priced. But the shift is that we can see now that there's potentially another 3 cuts in the pipeline. And then people will really eventually feel that exactly in those credit cards and car loans and mortgages you mentioned. And if that, obviously, the costs to that come down, then there's more space for the consumer to spend, to reinvest, and then get the economy growing. So that's why short-term interest rates coming down now is possible, because of lower inflation expectations. And with lower interest rates at the front end of the yield curve, we can spend more and grow the economy. So that's what every economist in South Africa was hoping for, and that's now coming true. So that's all. Yeah, it's really all coming together quite nicely at the moment.
So then maybe just to close the loop on the rand and our major trading currencies, but just for this conversation, let's keep it simple to the dollar. One of the things I would be saying to people is, you can't forecast what the rand does against the dollar, but what you do know is over a 20 or 30-year period, if our inflation rate is 6 and theirs is 4, theirs is 2, that gap of 4, the difference would count in reducing the value of the rand against the dollar over a long period of time, not day to day or week to week. It could be anything based on a president or a Rugby World Cup victory or loss or anything, but longer term it becomes a weight on the currency. So now we've got this lower inflation target, which means if their inflation rate settles at it feels to me like it might settle at 3%, the Americans, and we settle at 3%, then that one gap goes away. I mean, there'll be other reasons why the rand would strengthen or weaken, but that one factor now is either reduced or eliminated.
Well, that's spot on, Warren. I mean, if we have a similar inflation rate to the United States, we we shouldn't see too much of rand depreciation, which is a completely new feeling, right? Because we've all been through this, coming from 4, 5, 6, all the way up past 10 now to 20, and now back to 17. So if you could steady the ship at these levels, I mean, it would be amazing. But you are right, there's other factors as well. So I think we need to get our economy growing. I think we have to have lower interest rates, and with lower interest rates, get a stronger economy, keep up with US growth. If we can't keep up with US growth, the rand will continue to depreciate against the dollar. So there's more homework to be done, but this is a very important one, because that inflation differential, as you said, matters over the long term. Also agree with what you said, like, there's obviously a lot of noise around that. It might really be something like a Rugby World Cup, but it's also like, how do financial conditions in other economies change? How does market sentiment change? How do economies trade off against each other? We have the G20 this weekend, so what's going to happen there? Maybe there's a stupid statement against the United States, which will harm our terms of trade. I'm not saying it will be, I hope it won't be, but there will be a lot of volatility, but the long-term picture remains intact. And it's exactly as you explained it. Like, if you've got a similar level of inflation and a similar level of credibility around inflation, you should have a similar level of the currency. So there's no reason to believe that this time will be different.
And maybe then, I know we're deep into economic details now, but one of the things that I've noticed with the Reserve Bank is their job, they don't see it in their mandate to worry about the level of the exchange rate. That's not part of their deal. But they monitor the exchange rate because it can cause inflation. When the rand goes from 17 to 30, that causes, a landed price of oil, for example, to be higher, and that fuel has a big impact on inflation, all of those things. So I know that they would be quite careful, to cut interest rates too quickly, and then that causes the rand to depreciate, and then you get inflation. So they're not protecting the rand; they're focusing on inflation. But it's as you've been talking now, I'm realizing actually that if their inflation target is at 3, and it's close to our trading partners around the world, it does give them scope into the future to keep cutting rates without worrying about the rand blowing out again. They don't need to worry about that as the factor if you're getting that maintained inflation rate.
That is exactly right. So we do import a lot. You mentioned oil, and you mentioned petrol through oil, and then we also import a lot of food, which most people don't know. So there's a lot of imports, and with it, there's a lot of imported inflation. So you need that rand to be stable to avoid inflation, and with that, the SARB will, as you said, always monitor the level of the rand, and they can only cut if the rand is stable. But now the rand is even stronger, opening the door for cuts. And if we spin that story a little bit further, if you really would assume that inflation is at a similar level long-term than in the States, I think it will be slightly higher, to be honest, because we still remain an emerging economy, and the States is way more developed, they've got more productivity than us, etc. But let's say that gap obviously narrows now, the currency stabilizes, then it becomes a relative game on the nominal interest rates, right? And in America, we're also cutting rates, and we are at a much lower level than in South Africa. I mean, we moved to 6.75. In America, we're way below 4 by now, and we're going to see much lower levels. So with that, once again, agreed that you could now basically see more cuts if the rand remains strong and inflation under control, and maybe eventually even economic growth picks up, which it also actually seems like is happening. So with that, we could enter this kind of positive spiral, which would help us all quite a bit here.
And maybe just on unemployment, it feels to me, Stats SA also over the last little while published an update on unemployment, and those big measures at the very big numbers, we've got bad unemployment, but again, you've landed a phrase in my head now, momentum. So the momentum is not that unemployment is rising. It feels to me actually that it's turned. We're not saying that unemployment is halved or something like that, but it's incrementally better. And again, if the economy does start to grow, it creates capacity to take on more jobs, and that starts to get that positive spiral of reducing unemployment over time.
I think that's 100% right. It's just unemployment is our biggest problem, right? So with unemployment, there comes crime, etc., etc. So, and social injustice, all of that. So we need to get rid of that high level of unemployment. I wouldn't, even if we have ever lower interest rates and low and stable inflation and a strong rand, that won't be enough to eliminate our high levels of unemployment. A lot of our unemployment is structural in nature. So we need better education. We need less red tape. We need easier opportunities for businesses to create jobs. We need to attract way more foreign capital. We need to rebuild our infrastructure. So I agree on the momentum, and the short-term signal is probably a reason why that unemployment starts to be dipping a little bit. But we also need to be realistic. Like, there is a long list of homework which we still have to do to really see that unemployment come down materially. That's not just going to happen because of lower interest rates and a stronger rand. So there needs much more to happen. But nevertheless, I think we should celebrate the moment. We've done the right stuff. It's a step in the right direction. We just need to do many more of these steps.
And then I maybe just to kind of wrap this up, I feel when you look at things that have gone well for us, one of the things that's not getting as much attention around the world is that the JSE is performing phenomenally well relative to global markets. Even when you measure it in any currency, whether you measured it in rands or you measured it in dollars. And again, I know it's a moment in time, and there are lots of reasons for it, but it just does feel like we've had so much bad news where we've been shooting ourselves in the foot as a country, week after week, year after year, and now a few things going right, lots still going wrong. I mean, our news is full of crime and all the commissions that we're seeing, but at the same time, asset prices, for retirement money, like people that have got their big pension funds and RAs and all those things, those have done well, and it's a little bit of payback for quite a few years of growth that has been at best, kind of pedestrian. At worst, it's been capital destructive. So it's probably good to end the year, if we're talking now in 2025, to end the year on a relatively strong note. And there is a chance that, I'm not saying that we forecast the markets, but just economically that the economics are still going to be decent for 2026. And there's the potential for things to keep getting a little bit better every month for a while.
Totally. Yeah, that's spot on. I think a lot of our companies derive most of their revenue overseas, so I wouldn't necessarily link the strong JSE returns to our economy. Having said that, it's not meaningless either, right? What has happened is exactly what you said, that pensioners have a little bit of more money in their pocket. And actually, I mean, the stock market being up 40%, they actually got 40% more money in their pocket if they have quite a decent equity exposure. So it's not meaningless at all. And I mean, yes, we benefited a lot from higher commodity prices because our equity market is quite resources heavy. But that also means more revenue for the fiscus once again, and more attractive terms of trade. So, I do think there's many ways to see these strong equity returns, exactly as you suggest, as more like a glass of half full instead of a glass is half empty story. And we should celebrate those as well, and a lot of good news in that as well. And yeah, let's hope the year's coming to a positive end soon. We don't want to give away those gains again. So let's take them over and pass through Christmas.
It's probably the first time that I'm thankful that our stock exchange is not full of magnificent 7 tech companies right now. I think that would be a little bit more worrying. Bastian, before I wrap up, is there anything I've missed? Anything that you think we should cover, kind of leading into 2026?
No, Warren, I think you've missed absolutely nothing. I think it covered everything around the topics we wanted to cover. I think one thing I will say is it's always important to be mindful of the bigger picture. Like, South Africa is a small, open economy, and we are so subject to the ebb and flow of capital. So if global interest rates come down and risk sentiment is positive, money will flow into our economy and we will benefit and the rand will go stronger. But even if we do the right things as we do right now, if there's a big risk-off event globally, maybe driven by high sell-off in the Magnificent Seven, we will feel the pain here in South Africa as well. So always be mindful of the bigger picture, build diversified portfolios, cut through the noise, don't listen too much to the headlines. I think they deserve celebrating right now, but be mindful of the bigger picture. That's very important.
Bastian Teichgreeber is the Chief Investment Officer at Prescient Investment Management. Always good to have you on the show. You always teach me something, which I love. So thank you so much. And I'm sure we'll have you back on again.
Thanks for having me, Warren. Thank you very much.
The Honest Money podcast is brought to you by Prescient Investment Management. We consider everything to give you the advantage. It's the future of investing. Prescient Investment Management is an authorized FSP.